Okay, guys, right. So this is the cash book, and in a way we have already come across this the cash book. We've worked through this. This is the red book. You know the red book I gave you guys in class, where you had different columns, and this is what this chapter really is about. So in an interesting sort of way, we have done this already, but I'm just going to really introduce a new column. And that's what's really happening here. We've already discussed the fact that the cash book is used to record. Let's look at a couple of things that when we talk about the cash book being used for fundamentally, and this should allow you work through this chapter quite comfortably. First of all, the cash book, where are we? Sorry. First of all, the cash book is a subsidiary book. You know that, right? There's nothing new about this. It's a subsidiary book, first of all. And the cash book, if you like, is first of all, we use it to record any cash sales. And when I say cash sales, it could be cash sales, it could be bank sales, as in where you've received money, by check. Here you've received money by cash. The key point here is that we're recording information that we receive. We're recording, the receipt of money, basically. So either it's the cash or you've received a check. You record it in the cash book. Also, any cash payments or any check payments. Because if you remember, we have columns for both. We have columns for cash and we have columns for check. Thirdly, we also use it to record receipts from customers. Yes, receipts from customers. So we have sold to some people on credit, and that's the first transaction where A goes up, trade receivable, and I goes up, sale, credit sale, and then we receive money from them. So A goes up, money for either cash or bank, probably mostly likely bank, and trade receivable falls down or goes down. So debit bank and credit trade receivable. Yes, if you like. And fourthly, payments. Yes, oops, sorry, I'm out of space. Payments to supplies, which is pretty much the opposite of 3, when we pay our suppliers. Yes, because we have bought from them earlier on credit, if you like, and now we're paying them. So let's go through the PowerPoint. Let's see what's new here. Let's see if we can tidy this up pretty quickly. But this should help you deal with chapter 7 quite comfortably. Yes. Okay. So the cash book, here we are. We're going to talk about it as a subsidiary book. I mean, I've said this over and over again. The cash book looks exactly like the bank account in the general ledger. Just total formats. But anyway, the key point is that I want to focus on, if you like, it being a subsidiary book, if you like. That's the key point, really. But you know how to take the information from the cash book to the bank, to the T account in the general ledger. You know how to do that. And that's where I'm going to, you know that already. Here we are, subsidiary book for cash and bank transactions. As I say, it also acts as an account for cash and bank transactions in the general ledger. So, as I say, these are cash sales, if you like, straight away, or cash purchases straight away. So, it's a subsidiary book for those 4 items. Always remember that. And here we are. All receipts in cash, payments for cash, all receipts in checks, payments for checks. Yes, we have 2 columns primarily. I'll give you a third column, but I'll get there in a second. We have a cashier, someone who records these receipts and payments. Typically, there is someone who sits as a cashier who records both receipts and payments and who makes out the checks if you need to pay something, and typically you'd go to them to get the checks authorized. That's what's really taking place with your cash book. Yes, and you can see that this person really is in charge. So you have one person who solely looks after the cash book, right? And he is in charge of making sure checks are authorized, making sure checks are banked, things like this. So that's really, it's a whole department in itself. You have one person who looks after the cash book. Right. This is an example of a template, and you can see here. Let's look at this. You've seen this before. Nothing new here. That's the bank column, cash column. Right. I know we've put other things like others and things like that just to separate, money received from customers and money received from other situations. But this is the general template. This discount allowed column, we're going to talk about this in a second. And this discount received column, we're going to talk about in a second. But these are, if you like, this is primarily your cash book. You can see it's laid out in the debit and credit fashion. We've talked about this before. You know what's going on here. when we receive money. Let's go quickly. Cash is an asset. Yes. So if you like, this is an I. This is A. The cash book is all about A, the asset of money. Yes, either money in the bank or cash. We're not talking about income. That's sales. Yes, we're talking about the asset of cash. That's what this cash book is really about. It's an A. It's an asset. And of course, we've discussed what happens when it goes up, when it goes down, the dead click. Yes, I'm just stressing that again. We use the debit side for receipts. We use the credit side for payments, separate columns. And we also have this discounts received and discounts allowed business. Right, okay, let me just discuss this, this discounts allowed received business very quickly so that, you're comfortable when you see it. Okay, so let's take a simple scenario. Let's go back to I always want to start here. I think it's important. D plus E plus A is equal to, is equal to C plus L plus I. Okay, let's have a simple scenario. You sell some goods on credit. So say, for example, you sell something on credit for $5,000 to someone, and you have the asset of trade receivable. That's a trade receivable, and that's your sale, right? And that's I. So of course, so what happens is your A has gone up, and your I has gone up. Are you happy with that? Right. Say, for example, you really want your money quickly, and if you like, you would like the person who owes you money to pay you quickly, you might offer them, yes, I'll say that again, you might offer them a discount. You might say, you know what, if I say, okay, you know what, just pay me $4,500 and we'll call it quits, yes, just pay me $4,500 and we'll forget about the trade receivable. Because right now you have an asset of £5,000, right? So basically you're saying to them that you don't really want a piece of paper that says you're owed $5,000. You want a piece. You just want the money. You want $4,500. You want $4,900 or whatever. The key point is that you give a discount. You say, you know what? I'll give you a discount if you pay within 7 days. If you pay within a day or two, you can just pay $4,900 or $4,000, whatever the discount is. We're assuming it's £500 today. So okay, then let's see what happens. The person says, you know what? I'll take it. I'll give you £4,500. So let's just go here. Let's go to another color. And the person says, you know what, I'll give you £4,500 if you like. And if you like, now you have £4,500 in the bank, but that means the asset, if you like, of trade receivable goes from 5,000, if you like, minus, if you like, yes, because we need to subtract, yes, we subtract 4,500 from here. So technically, what your new thing looks like is this. You have 500, this is what's showing so far, trade receivable, 4,500 in the bank, and that's equal to the sale of 5,000. So you have said to that person, you know what, forget about this 500 here. You said, you know what, forget about it, but you have 4,500 in the bank. The question is, how do we deal with this 500 that is apparently still being owed to you? So technically what you've said is, forget about it. To a certain extent, you have lost 500. You have given up 500 to get 4,500 early. Yes, that's what a discount is. And this is referred to as a discount allowed. Yes, this is a discount allowed. So a discount allowed, yes, is given when you have sold something to someone and you say to them, listen, don't pay the full amount. Just give me, whatever, give me a certain amount and forget about the rest. And in accounting, we consider this an expense. Now, the important thing is this. If you leave this 500 there, sitting here, we're always going to think that we have this asset of 500, but you don't have this asset of 500. So what we do is, to get rid of that asset, we say, okay, you know what? Let's get rid of that asset. So we deduct, if you like, or we get rid of the 500, if you like, which is trade receivables coming down, and we create an expense of 500. And this expense of 500 is called discounts allowed. Yes. So what's happened here? We've created an E to get rid of an A. So when E goes up, A comes down. That's how we deal with the double entry. Yes, you're quite comfortable with these arrows now. So you can see here we had this asset of trade receivable. It falls because we incur an expense of 500. Yes, as a new expense. Yes. I mean, technically, you could have reduced I as well. You could have dropped TR and dropped I. But what we do is we create the expense of discounts allowed. And really, the source document technically is the sales invoice because we make a note on it. But the cash book, really, let's go back to that. Let's go back to that PowerPoint. You can see here that in your cash book, when you receive the money, for example, if you put a figure in here, you know, if you write, say, oh, Jack Jones, you know, when you write the money that he gives you, you only put the money, you put the actual money, it's the actual money you record in the bank column. You don't put 5,000 in there, you put 4,500, and the discounts allowed column, it's not very big. I'm going to try and make that bigger. Let me see if I can expand that. Still not very big. I'll draw one up right now so we can just see what's going on with that. Yes. So you can see here, if this is your cash book, where you have a bank here and cash, you have discounts allowed. So for example, you receive 5,000 from 4,500. Let's just say this is Jack Jones, and you receive 4,500 because you've said, you know what, just give me 4,500. Forget about the 500. You would record the 500 here. Yeah, so we can clearly see that, you know, you've given up a discount of 500 and you have only actually received 4,500 in the bank. It might have been cash, I don't know, it doesn't matter. But the key point is that you record the fact that you have given a discount, you have incurred an expense, if you like, for trying to get your money early. Yes, so that's really important. That's what's referred to as discounts allowed. Yes, let's look at the discounts received. This is the opposite. This is when you are given a discount. So let's look at the D is equal to C plus A. D plus E plus A is equal to, let's go here, and that's C plus L plus I. So what's the situation here? You buy some goods on credit. Yes. So where are we? Let's get some colors here. So you buy some goods, say 4,000, right? You buy some goods on credit, and so you have a liability of 4,000. Yeah, E goes up, L goes up, and you buy some goods, say from Michael Jackson. Michael says to you, you know what? Just pay me whatever. Pay me 3,000, and we'll call it quits. Because he wants his money early. He doesn't want a trade payable. You know, he doesn't want you to be owing him. He just wants his money. He says, pay me 3,000 and forget about it. Pay me 3,000 and we'll scrap anything else you owe me. So, okay. So you say, okay, you know what then? Fine. You give him 3,000. Of course, 3,000, your asset of money goes down. And your liability goes down by 3,000. Well, yes, it's gone down by 3,000, but there's still a 1,000 outstanding, isn't there? You know, technically. So the question is, how do we get rid of that 1,000? Well, if we leave it there, because right now, if we leave it there, we'll have this sort of situation where we have, you know, an outstanding liability of, if you like, 1,000. And we don't want that because you don't owe him 1,000 anymore. He said to you, forget about it. It's okay. You take it. Well, we need to get rid of it. So if you're going to get rid of it, the question is, what's going to move? Right, so if you're going to get rid of that, what we do is we say, well, technically, you just technically sort of have received a certain type of income, if you like, and we call that discounts received. He's basically said to you, you know what, don't pay me the 1,000, forget about the 1,000. So, you know, we could reduce E, but that's not really the case. You know, you did actually get £4,000 worth of goods, so we can't really touch E. And we can't say the value of goods in E are worth less than 4. We can't say, well, really they're worth 3. No, you got a discount. So we recognize the discount of £1,000. And that's how the arrows map out. Always think of it this way. So this is, if you like, a receipt. Yes, it's a receipt. It's an I. Technically, it's like I going up. So it's a credit. Yeah, so what's really happened here is that we're debiting. Yes, because this has gone down, we're debiting the liability. Yes, we're getting rid of it. And we are crediting discounts received. Right. So let's go back to the PowerPoint and see if we can look at this again. So we have discounts received on this side. You can see that when you're paying, yes, where were we? And let's just see. we are here. Yes, we talked about the discount columns. Okay, so let's just go through a few examples. Here we are. Okay, this is let's look at this example. So here we are. We have a certain Mr. E. Doyle. We sold to him a while ago for £80 on credit. He pays us a check, but we allow a £5 discount. Right, okay. So really, as I say, I'm not too bothered really what the source document is right now. You could argue that it could be the invoice. You make a note on it, or when he sends you the check, he only sends you £75, right? And so you have the check that you've received, or but really, I think the source document is probably a better. The invoice is actually probably a better source document, because you'd have made a note on that. The check would just be for the amount. That's not really evidence of the discount, is it? Okay, so you record a receipt of 75. That's what you record, 75 on the bank, and you record 5 in discounts allowed. Yes, it's really important. That's what you do. Then you pay wages. Oh well, you just pay wages, and that's fine, normal. You just put that through. And here we are. This is another nice example. You receive £190 from A Sparks in full settlement of our account of 200. So basically, what's really happening here is you've said to A Sparks, you know what? Give me £190. Forget about the £10. You're basically taking a hit of £10, and that's an expense, and that's what we refer to as a discounts allowed. You've allowed a discount. Okay. Always think about it from the point of view of you, yes, as the owner of accounts. Have you allowed a discount, or have you received a discount? You receive a discount when you are paying, right? Okay. And this is another example. So you send a check of £75 to settle an account that you owe, that you had earlier bought some goods on credit for £80, and you're sending a check for £75. So technically, you have received a discount of £5, right? So, so I think those are the key points really with discounts. I want to tell you what happens when you are dealing with the balancing of these. It's very simple, very, very similar, nothing different. We're interested in totals, yes? Nothing's changing. In your cash book, as you have done before, you simply take the totals. I'm just going to talk about the discount columns now. In the same way, this is a subsidiary book. Yes, on this side you have your discounts allowed, and here you have your discounts received. So it doesn't matter. It doesn't matter if you have 50, 100, 150. Here you have 20, 30, 45. The key point is you take your totals. Yes, so that's 250. You have your total 300. Like you have for everything else, we're only interested in totals. Totals when we're talking about the general ledger. And here we have, they have two separate accounts. There's not one. There's not like one big discount account. There's a discounts allowed account. There's a discounts received account. So we have 50, we have 95. So what's happened here? Once you got your 300, what have we said? We have said that we have allowed £300 to our trade receivables. That's what you basically said. So what is your double entry? Well, your double entry is, it's just a shame I don't have much space on here, but your double entry, I'll just talk about the 300. We'll come back. We know this is 95, so we'll keep that in mind. Yes. So what are we saying? We are saying fundamentally that we have this. This is what we have. Trade receivables. And we have this new expense called discounts allowed. 300. And here 300. Yes? That's what we're fundamentally saying. Let's look at the logic of this. We've talked about it using the accounting equation. Let's take a simple scenario. Imagine you had earlier sold some goods to someone for 3,000. Yes? This is the situation you'd have had, right? You had sold some goods for 3,000 on credit, so you were owed 3,000. You had sold some goods for 3,000. And the person says to you, you know what? Just pay me 2,700 and forget about it. Oh, sorry, I'll pay you. So you say to the customer, you just pay me 2,700 and forget about it. You know what? I'll accept 2,700. So you accept 2,700. Here's your bank. You get 2,700. Well, because you're going to have to forget about it, we need to close this account, remember? Because there is no balance carried down. So you must get rid of that 300 that's sitting there. It's not a balance carried down. Ordinarily it would be, but it's not going to be. So you have 300 here, and of course you suffer an expense by creating this account called discounts allowed. So this is an expense, yes, and of course you know that expenses are going to start hitting our profits, I minus E. Yes, and so that's how we deal with it. So we close off this account, 3,000, 3,000, done. That's that, done. So this person's clean, nothing else. You can see the bank has only received 2,700. So, and we get this figure, this 300 here, the total of this, of course, from your cash book by adding together everything in the discounts allowed column. And the same thing happens. The same thing happens with the discounts received column. Yes, the same thing happens with the discounts received column. Yes, that was 95. If you remember, if you go back on the video, you'll see the discounts received column was, remember, the discounts received column. This is your cash book. This is your discounts allowed here. I'm just looking at those columns. It was 300 here. I think it was 95 here. I'm only interested in 95 now. And what's happened here? Let's look at what's happened here with your discounts received. Well, what happened? Let's start again. You bought some goods. Purchases. Trade payables. You bought some goods. Let's imagine for, say, £3,000. 3,000. Trade payables, 3,000. He says, you know what? Just pay me 2,905. Okay, then you're like, okay, I'll do that, no problem. So out of your bank, 2,905 comes out. So of course, it's 2,905 over here. Yes, because you're reducing that. Well, you don't owe him anymore. So it must mean that whatever it is to close this account must go to your discounts received. So you can see your discounts received is a type of income. It's on the credit side, very similar to I. You have received income. Yes, and this is how it feeds, if you like, goes into the general ledger, the T account. And this is made up, it's a total. We're interested in totals. So you add up all your discounts, and then this is how you deal with it. And you see this trade payable closes. It's done. It's over. 3,000 and 3,000, and that's done. And this is a source of income, if you like. Yes, and you do your normal thing, balance carried down or whatever, 95, and you close this. Then you have balance brought down, 95. Yes, and of course, same with purchases. You do purchases and you do bank, and then you just have your trial balance, and you'll have discounts received as income and discounts allowed as an expense. A couple of things, just some theory. And this is to do with some vocab here. Yes, a standing order. Now, a standing order, say for example, you pay a gas bill, right? And a standing order is a situation where you say to your bank, yes, you say to your bank, let me make a new. So here we are. Here is you, your gas company, and your bank. So a standing order, this is really important. You say to your bank, give gas company £50 a month. You instruct your bank. This is important. You instruct your bank. And you say to your bank, I need to pay a bill every month. You instruct your bank, telling them to give gas company £50 every month. Simple instruction. And your bank does it. You have control over it. You can change it whenever you like. And that's it. As opposed to a direct debit. A direct debit is a situation where we have, let's say, let's go back to gas company. And that's you. And that's your bank. A direct debit is where you sign a contract with gas company. And you say to gas company, I allow you to go to my bank and take out £50. So your contract is with the gas company. It's almost technically, fundamentally the same thing, but this time your contract is with the gas company and you sign a form instructing or allowing the gas company to take money from your bank. This is not a relationship technically between you and your bank, it's a relationship between you and your gas company. So the gas company go to the bank, take out the money. So if you want to stop this, technically, if you want to stop this direct debit, you need to go to the gas company to stop it, not technically your bank, because you signed a contract with the gas company. And it depends, really. You can see that it's really a legal issue. Sometimes the gas company would want you to sign a contract with them so they can go directly to your bank. But if they trust you, they'll just say, why don't you just go to your bank and set up a standing order? So that's really what's taking place with them in terms of that vocabulary for this chapter. And a credit transfer, that's when money leaves from one account to another, if you like. Yes, that's just online banking, really. So those are what credit transfers are. Money coming into your bank online. It's not by check. It's just coming online. And bank charges, if you like, a bank is offering you the service of owning a bank account and keeping your money for you. So they charge you from time to time. And as you can see, that will appear on your bank statement. And you need to check your bank statement from time to time to update your cash book. Because your cash book is supposed to look exactly like your bank statement, which is what we talk about in the next chapter. Okay, great stuff. See you then. Yeah, sorry, by the way. That should now help you out for working through the questions at the back of chapter 7. But just do as much as you can. And yeah, try and get through most of them. Okay, good luck with that.